Welcome to the Millionaire Journey Podcast. The goal of this podcast is to guide and empower you on your journey towards financial independence. Here's your host, Lien.
Today, my guest is Brian Seidensticker, co-founder of Tax Sale Resources. Welcome, Brian.
Hi, Glenn. Thanks for having me.
Yeah, glad to have you on. And, I read about your profile and I thought it was really interesting. I've always heard about, finding properties, tax liens and stuff like that. Have almost no idea how to do it. So it'll be, should be a good podcast.
All right. Don't worry. Most people don't. I certainly didn't.
Yeah.
When I first heard about him, I was on the wrong side of him, but certainly we can dive into that here in a bit.
Cool. So if you could just tell us a little bit about your story.
My story. Well, I think contrary to maybe some people's beliefs, I did not grow up as a young boy with aspirations of being a tax deed expert. Actually, I grew up really for most of my childhood that I remember wanting to be an astronaut. I did end up going on and started my professional career as a aerospace engineer, working in the really the missile defense space. I worked for a private contractor that built both the targets as well as the missiles, right, that shot down, I'll say, bad guys' stuff in space. And I was on the target program doing some pretty cool sounding things. And actually, as far as the job goes, it was what I thought a bit of a dream job, not necessarily dream as in like once I got into it, and everything once you get into it isn't quite what you assumed it was going to be. But as far as if I were to paint a picture and the type of stuff that I would want to work on, it was it. And really loved what I was doing. I actually ended up going on vacation for 6 weeks down to Brazil and came back. And prior to this trip, I always felt like I'm on doing all this work on a daily basis, right? And there's always so much to go that needs to be done. And I left, I came back, and it felt like nothing had changed. It was like 6 weeks of me really being unplugged. It's not like I kept any of the balls in the air, but I picked them right up where I left off. And it was kind of an epiphany for me. In that, okay, maybe I'm not getting as much done on a daily basis. Maybe this is a hamster wheel, and I needed to find something else that gave me that gratification of accomplishing something on a daily basis. So that was kind of my shift in mindset. I good or bad, I did. I'll say I was smart enough not to just walk in and give my 2 weeks the next day. But definitely changed my mindset and got me looking at like I need to do something else. And I had already kind of started looking at something else. I was flipping a couple properties, nothing on a large scale. I was flipping properties in 2007, 2008. And actually how I got introduced to tax sales was I was on the wrong end of a tax lien on a house that we were in the middle of a remodel. And I'm originally from Montana, and this was in Montana. I didn't know this at the time, but Montana has some strange statutes around tax lien investors and what they have to do. And every potential investor, here's the thing, is every potential investor has to send a certified letter to every homeowner that they plan on buying a tax lien certificate from. And so I got like 45 of these letters in the mail, each of them slightly different, but with similar, threatening language of you could lose your house to this. And I was like, and the amount that was due was minuscule, right? I was upside down in a house, and it was kind of one of those like, why put more money after bad, knowing that I'm gonna have to do a workout here anyway. And so we hadn't paid our taxes, and so the tax amount wasn't like a ridiculous amount. It was just like, wow, is this actually could happen for this small of an amount due on a property? But anyway, that situation was rectified, pay the taxes, worked it out. But it basically made me go, what is this whole tax lien space all about? Got me going down a different rabbit hole, which I'm certainly good at doing. And Glenn, if I get too far down any rabbit hole today, certainly yank me back out and say, all right, let's get back on track. But
yeah,
I started going down this rabbit hole of tax lien investing. Did as much research as I could find, and there wasn't a whole lot on the space at the time. But basically found that this is a real thing. You can buy tax liens at sales. In some states, you can buy them directly from the county. And you end up owning this, tax lien certificate. And I ended up going out and raising, I'll say a fund. It was not a large fund by any means. It was just some friends and family money, and started buying tax liens in really Montana and Wyoming. Which, funny enough, again looking back, hindsight's 2020, it's two of probably the worst states to buy liens in from a return standpoint. It's not horrible. It's right around 10%. I think Wyoming is 11. But there are states where the return can be significantly higher. But there was no resource out there to know this. I didn't know anybody. There were individuals at the time. There was a National Taxing Association, but I wasn't aware of any of that stuff. And so anyway, I started down this journey of essentially building a database for internal use, right? Okay, if it's not out there, let's build it internally. And I built a web. This is before, Google Drive and OneDrive, and there's way better resources today that would solve this without me having to build a website to do it. But I guess took advantage of my engineering background, built a simple website, and purely for the purpose of I was in Arizona still working at that aerospace job. My sister, who still works with and is a partner in the company today, she was in Montana still, and really just to share information back and forth. Hey, can you research these counties in these states and fill in this information, and started building out this online database. And that was in 2008, 2009. We had a real creative name that I put on the domain called taxliendatabase.com. It wasn't, and really didn't even have, it wasn't monetized. It wasn't until I went to a conference in 2000, I think it was late 2009, in Orlando, and there was a guy there, and I was just showing him what I was doing, and he basically said, "You know what? I bet if you made this information available and with a paywall, right, a subscription base, you might get some revenue off this. At least make a little bit of income." And I was thinking of it as like, okay, well, I'm trying to pay my sister. I don't like, liens are great maybe from a return standpoint, but it's not the best like monthly cash flow. You only get paid when lien redeems. So I basically said, okay, that sounds awesome, and converted that into what is now taxsaleresources.com, and the platform was born. And within a couple of years, the revenue I was getting from the data sales essentially way outweighed what I was earning from the fund, if you want to call it that, from the lien investments. And I basically abandoned lien investing directly and started doing the website software thing full time back in 2010, 2012 timeframe. And that's basically what we started out doing and have grown that. Now we do this nationwide. We track roughly 8,000 different tax sales, between tax liens and tax deed sales. We do both. And there's actually a middle ground we call redeemable deeds. And it adds up to about 1.52 million properties annually, and about $8 billion is really what the industry as a whole is on an annual basis. And so what is easy now to go find out simple things like, where is this auction? When is it going to be? What are the properties related to it? All those things that didn't exist. That's exactly what Tax Sale Resources does.
So real quick, there's a few things I'm kind of like,
all right,
I don't understand, and I feel like I'm entrenched in real estate. So I feel like I'm like, maybe we should ask some few questions.
Go for it.
So what is it that you're looking for as like, say, an investor? Like, what is the thing that you're looking for to buy? Like when it's a tax lien?
I'll break it into two different buckets. Tax liens are very different in my mind versus tax deeds, right? I think you probably relate a lot more to tax deeds, right? And the tax deed is essentially you're purchasing the property, right? The actual real estate at the auction, due to a foreclosure, and that foreclosure just happened to have occurred due to delinquent taxes, right? And so, what you're looking for from that perspective is not that much different than you or any real estate investor is looking at. I want to buy it at a price that allows me to monetize this at a either renting or reselling, right? Flipping it at a price that makes sense for whatever your model is. That's the tax deed side. And I put redeemable deeds, which is this weird middle ground, in the same bucket, just because most auctions in that realm mirror buyers looking for the real estate. Now, tax liens, on the other hand, is much more of I call micro mortgage investing. You're a note. You're not buying the property. You have no rights to the property. You're buying an interest in that property that happens to be secured by a tax lien. And so, what you're looking for from a tax lien perspective is more of a, hey, when, is this going to redeem, and when it will redeem, right? And that's what guides your model on how much you're going to make from an investment.
Okay, so what is considered redeemed?
So, all right. So I guess take one step back of what the heck a tax lien is.
I'm somewhat lost.
So, all right. So an owner doesn't pay their property taxes,
yes.
Right? Well, at least in today's world, I've been told there's two things that are guaranteed, taxes and death, right?
Yep.
Those taxes is real estate taxes. And if you don't pay those, counties today, right? I think this holds probably everywhere nationwide. They need to balance their budget. They don't have like billions of dollars in a fund that they just go pull from, right? They gotta they need that money to pay policemen, to pay firemen, to pay teachers, to pave the roads, right? They gotta operate. And so what they do is if you don't pay your taxes, they put a lien on your property, right? And then they basically turn around and sell that lien to an investor, right? And basically what the investor does is give the county what they're due from a tax perspective. And then that lien, carries a penalty, and that penalty comes in the form of an interest rate. And so when it's like 98% of property owners do come forward and pay their taxes, they pay the original amount due plus the penalty, which is an interest rate. And that interest is what ends up going to the investor. So
that's where in Montana, you were saying it's only 10%. So it's not even as good as some other places. So when you're buying this, it's almost like you're going to get paid eventually, ideally. Is that what is kind of?
From a lien standpoint, that's the goal. There used to be, until recently, there was a Supreme Court case that came forward in the last 2 years called Tyler versus Hennepin. But used to be, there were some states that allowed you to, if you own that lien, right, and after 2-3 years, if nobody paid it off, you could essentially convert that lien into a deed, and so you in theory could own the property for the amount of taxes. Now, Tyler Hennepin Supreme Court case basically said that model is not constitutional, and the states that had that mechanism most of them have, and the others are on track to change their statutes, so that doesn't exist anymore, right? So there has to be a different mechanism for selling the property through a foreclosure action.
So real quick, so I think that I've known one person that does this in Florida, and I think the way that she would do it is she would buy it and it'd be like $6,000 for a lien, and then she would actually take back the place, and then while the lien is due, she would actually rent out the units to collect rent to be paid, and then she would be paid on the back end. And then her hope was that she would actually get the property back. That it wasn't to like screw over the tenants. It was just like she bought the lien, she renovated it, and then she would actually have tenants move in, and then hopefully that the lien wasn't paid back. I think is that something that you've seen or like what you're talking about?
Well, that did exist in some states. It does not exist. Never really has in Florida specifically.
Okay.
It doesn't mean that she might have been doing that in another state.
It could have been condo fees to also, like it was like they were delinquent to the condo, so she paid the fees, she held the condo, and then I think that it might have been that she was waiting for like it to go to where she pretty much claims the property after that, I think.
I'm not as familiar with the condo side of things. I know the way Florida works from a tax, property tax perspective is they initially sell a tax lien, right? And you don't have any rights to the property while you hold the lien. And so I don't know if she may have been coming in the second half of that story, which is when in Florida there's a 2-year redemption period, and where the owner, like, they don't lose rights to the property. They have, at any point they can go pay their taxes, and there's nothing the lien holder can do to prevent that. And the lien holder should not and has no right to go do anything to the property. But once that 2-year period is up, the lien holder can file essentially a foreclosure action. It's called a tax deed application in Florida, is what they call it. And that culminates, right? It's basically kicks off a foreclosure action, and that culminates in what I call a tax deed sale. And so at the tax deed auction, you go and you're able to actually buy the property. And that is a deed that you actually get. Now you do have rights to the property. The previous owner still has, and this might be where that person was coming in, because the previous owner, until you quiet the title, the previous owner can still come in and reclaim that property. They have to pay a lot, and there's more of a negotiation to it. But you can remodel the property. You can put tenants in it. You can do all that. You have a deed to the property. You have rights to the property. That's from the deed, not the lien. Is that
okay? Hey guys, if you want to learn more about our deals we're investing in, go to our website and sign up for our free ebook, 10 Reasons Mobile Home Parks Outperform Other Real Estate Investments. We won't spam you. We'll just keep you updated on the podcast and the deals we're working on. Now, back to the show. Yeah, so you were talking about mainly just tax liens, and you were going to go into the tax deed also?
Correct. No, I'm going to use a different state. So there were states, Florida's always been that way, with the lien sale first, and for the county to recover their money, right, and the deed sale to sell the 1% to 2% of properties that don't redeem, right. The property owner never comes forward and pays their taxes like they should. There were states that didn't have that deed sale process, and so she may have been doing this in other states where you can buy the lien. You wait a couple of years. If the property owner doesn't redeem in that scenario, there was no deed sale in that state because this is state governed, right? And what instead happened is you would basically send in that lien. The county would issue a tax deed. There was no sale associated with it, right? And so in theory, you would end up owning the property for the amount of taxes. But that model is essentially no longer. That's what was struck down by the Supreme Court case hearing, saying that states can't have that mechanism. They called it a taking clause, and I think they said the right thing and did the right thing from my perspective, because there are two things they address, right? County shouldn't make this a profit center. They need to operate with the cash that they need, but they shouldn't make it a profit center. And two, you shouldn't be able to take something away from somebody for less than maybe what it was worth at the time, right? They should be compensated in some way. And so taking $100,000 property for $1,000 just didn't jive right? And I agree, right? Great from an investment perspective, not real constitutional. So, well, yeah, I guess what I was speaking to is really from a lien perspective, right? What you're looking for is you're not looking to own the real estate, especially now with the change in statutes. If you want to own the real estate, just go to the tax deed auction and buy the real estate. And so if you're buying liens, you're looking at it purely from a paper investment standpoint, right? How much can I make off of this? And so you're underwriting it based on when you think it's going to redeem, right? Because like Florida, and I'm getting pretty complex here, Glenn, but Florida has a penalty, right? So there's a 5% penalty that if somebody comes and redeems it the next day, you make your 5%. That's great when you annualize that. And then there's an interest rate on top of that you can earn over time. And so there's certainly people in Florida that try to target liens that are going to redeem in 30 days, 30, 60 days. Because if I buy those liens on a large scale, right, put out your $1 million, right, in 30, 60 days, you make 50 grand. That's not a bad annualized return. Now you got to go find something else to do with that money the rest of the year, but you've made a quick buck and you can move on. But in general, the lien buyers aren't looking at it from a real estate ownership perspective. Now, they do have to make sure properties are worth it at the end of the day, because counties don't tell you what you should and shouldn't buy. That's kind of where taxable resources comes in. We give the data, like counties just say, here's the parcel number, right? Buyer beware, right? And they have, when you look at how counties are carved up across the country, I have yet to see one that was like perfectly carved into nice little squares and every parcel makes sense. Usually it's weird shapes and you end up with these wonky looking parcels that I've literally seen one that was, all it was a mailbox. I've seen one that's like a 10-foot stretch of sidewalk, right? Sometimes it's a 50-foot stretch of road, right? And what value is there in a 10-foot stretch of sidewalk? Not much, right? So is somebody going to come forward and pay the taxes on that in that redemption period? Probably not. Can you foreclose on it? Sure, right? You end up owning a 10-foot
mailbox
sidewalk. Yeah, like what are you going to do with that? So you do need to underwrite it, right, from a perspective of making sure the underlying asset and value is there, but you're not as concerned with the value of that asset as long as it has value and making sure that it covers the taxes that are due. Does that help?
Cool. I feel like I got just enough to get in trouble. Yes, I got it down. So
Well,
let's talk about like what is that what's your business and how does that work?
yeah. So, and I guess when I say get in trouble, I think my goal is for folks to at least understand enough that it is fairly complex. And there are folks out there saying that this is a guaranteed investment and you can't lose. And like, trust me, there's many ways, to lose your money, and many pitfalls you can fall into.
What's one way that you'd lose your money?
Well, I think one of the biggest ones is, like I just said, people kind of go to these auctions and they buy liens on they think they bought a great lien and it's great return, right? And then they go to file for a TDA and then it doesn't sell, and they end up with this real estate, and then they finally look at what the property is and they're like, oh, this is a chunk of sidewalk, or this is a mailbox. They never really underwrote the lien from a right way because they just assumed that it was guaranteed, and that's not the case. That's probably the most common, like I'll say, pothole you can fall into, and a lot of people fall into without doing some initial.
There has to be. I'm just going to ask it. Is there like funds that go out and just really try to find the best deals, like say $10 million, $100 million funds that go out and do this? Or is there people that do this?
The largest fund that I'm aware of in the space is about a $500 million fund, and so that you can get pretty mad. That's on the lien side. There's several funds that are 5 million plus in the space, and they're doing that in a fairly large scale, and they do have some capability. Like here in Ohio, most of the counties sell their liens on an RFP, or request for proposal, and so in those you're not just buying one lien at a time. You're buying the full counties, right? So I
Wow.
think Cuyahoga's is like $10 million at a time.
So they're buying
Well,
the mailbox ones too.
they have to take the good and the bad, right? But that's their underwriting. And when they submit their bid, they account for that, right? Like, we're going to get losses on these. We're going to make money on
Wow.
these overall. We'll pay you, right? So you have $10 million in delinquencies. We'll pay you $8 million. I don't know. I'm making this up,
Nice.
right? I'll pay you $8 million. So they've accounted for all that. They're a little more savvy than your standard,
Yeah.
beginning investor for sure.
Cool. So then, I guess it's just like all real estate. It's all in the buy. When you're trying to buy low, sell high,
Yep.
and then also trying to make sure something that's tradable. When you buy real estate, I always see like there's like houses on busier roads. It might be a deal, but at the same time, you're going to have a hard time selling it later.
Yes.
So
Yes, and that's exactly right. And liens are in almost all states. There's a couple that you can transfer the tax lien. You don't have to carry that forever. You can actually assign that through and sell that tax lien, right? And I guess that would be another thing for folks I've seen tax liens being sold on eBay, right? This is a fairly unregulated space, and they're selling the tax lien on eBay, basically saying, "Hey, here's a property tax lien," and they're trying to sell it for a percentage of property value. And in reality, that lien is the paper is truly only worth what it's going to redeem for, right? So selling a $1,000 lien that might redeem for $1,300 a couple years in the future for $30,000 is not, I guess technically it's somewhat legal. I wouldn't recommend anybody doing
No.
this. And I think
You're
you're just
expecting to
asking
foreclose it. Like if that were the case, you'd be the one that you'd want to foreclose on the
yeah,
property, but
yeah,
that might not even happen.
that might not even happen. And in today's changes, 98% plus of liens nationwide redeem. And so chance of owning that as real estate is slim to none.
Yeah.
Right? And then on top of that, like that whole process is being eliminated. And so you can't own real estate in the states where you could at one point in time through that mechanism. Now it's a dinosaur that's still alive. That's, the end is coming. Because there's states that have changed their statutes, but they don't take place until 2026 and that sort of thing. But it's just, don't go there. Like that's just not the best place to go
Yeah.
buy.
Doesn't seem like it's going to be a profitable venture. So
Nope.
how long do you think it takes for someone to be foreclosed on from not paying taxes on a property?
It varies by state.
Yeah.
And so anywhere, there's some states that are 6 months. There's some states that are 3+ years. And that's to basically start the mechanism of a foreclosure action. Now there's usually months, if not years on top of that, added to, the time before a foreclosure actually takes place. And so you're, in general, you're multiple years, 3 to 5 years from a lien ending up, like if you're a delinquent homeowner, from that lien ending up being converted into being sold to somebody, right? And so you have plenty of time to go pay your taxes at any time during that process.
So would you say this is how would you say would this be the place where you put your investment dollars, or like where do you mainly invest into?
So I guess kind of back to my story. So in 2017, we started providing more and more data to tax deed investors, the guys that are buying it from a real estate perspective. And the common feedback we got from our users was they're all just very cash limited. And the primary reason of that is because you have to have the cash at the auction. That's hard enough. But then you don't have insurable title from the county. You can't go to, and because you don't have insurable title, you can't get title insurance. Because you can't get title insurance, a bank isn't going to lend you money, right, on this property that you just bought. And so everybody that was doing it successfully was cash strapped. I mean, some might have even $1 million, right? But there's only so many properties you can buy with $1 million until you're basically sitting around waiting for one to sell to free up cash to do it more. And so we with this feedback basically had the concept of, hey, if we can get a lender to provide capital in this space, there wasn't one, not an institutional one. If we can do that, then we'd enable our customers to buy more, obviously use our services more, right? And so it was kind of this, hey, we'll solve this problem for them in some way, and then we'll get income from it at the end of the day from more subscribers, being with us longer, paying more for the services we provide. And we started talking to a bank that we knew and had a relationship that provided lending in tax lien space, right? So they're lending on liens, but they weren't lending on deeds, and started to try and get them comfortable with making that transition. And actually, at the end of the day, they were happy with the model. They were happy with the financials. They were on board, and essentially came down to they just needed to submit a letter to the SEC asking them for where to put these particular loans. Like, what bucket is this? A real estate security or is this real estate? Right? Because they have, and I'm not a banker, I'm not an expert in that space, but they have different regulations that to follow, and they have to keep those very separate. Interestingly enough, the SEC came back and said, we're not going to tell you where to put it. And the bank essentially said, well, we love the idea, but if they're not going to tell us where to put it, we're out. Right?
Yeah.
It's basically, they took it as, we don't care where you're going to put it. We're going to come after you, nail you with fines no matter where you put it. And
depends on the senators there will be who come when we come after you.
Yeah, exactly. So we were, anyway, I'm a big believer in one door closes, three windows open, pick one. And so this is in 2019, we're like somewhat deflated, but, said, well, okay, well, if a bank won't do it, can we start a fund?
Yes, private,
right?
Which means a higher interest rate.
Right. And so that's basically what we've done with Mountain Earth Capital, which is a sister company. We put together a fund, proved that out, with about $1 million in fund one, and then came back and raised about a $5 million fund in fund two, proved out that we could scale it. And then, really in the last 2 years, we've started fund three, and have scaled that to about a $35-40 million fund so far. The sole intention of, we are working with local tax deed investors, buying the properties, we're their capital partner, and have solved that capital intense problem that they have, or cap shortage problem that they had. And so back to your original question that I started answering, 5-10 minutes ago, all of our investments are really in the tax deed side, or not entirely, but most of them. And that's purely out of, we find a larger return with the data analytics that we have and utilize, that if you can buy the properties at a big enough discount, right, and and then disposition those properties, you will make a higher return than your typical lien, redemption rate. Now, it is certainly much more hands-off. It is, I think you mentioned the mobile home space, right, which is the most unpassive, passive income, right? And tax liens are much more passive, and tax deeds are not passive in any way, shape, or form. So there's a lot more work involved, but return-wise, that's where we've taken that on. And I think a lot of the tax deed investors that we work with, it's a great partnership, because they're the ones doing the work on the ground. We're just the capital partner, and then we make it work at the end of the day. So we kind of ended up solving our own problem and creating a whole new business unit at the same time.
So it's kind of like, we'll say these deed investors are more, we'll say, like house flippers, because what they're doing is they're just trying to clear up the title while they own the property. Is that what's happening?
Yeah, almost every, the majority of our folks that we're working with, the partners that we're working with, are either fix and flippers, right? And I still think when you watch like the HGTV shows and fix and flip or whatever, they walk in the house and it's just stuff everywhere and it's a disaster. Every time I see those episodes, I'm like, that was a tax sale property, because that is what tax sale properties typically are. These are not the standard, I'll say, mortgage foreclosure scenarios, where mortgage foreclosures are usually livable, right, and in decent shape. Tax sale properties have been sitting delinquent for years, right, and they're delinquent and nobody's paid it for usually a reason, and many of them are abandoned, right. So these are rough properties, and so the money to be made there is on the value add component, and so the vast majority of the folks that we work with are the fix and flipper type folks. Now there's certainly a secondary avenue for folks that we work with that they do that, right? They fix and flip it, but they fix it, but they don't flip it. They hold it, turn it into a rental, where you can get a grade B rental for, $100,000 or less, right? You buy it for 50, put 50 into it. You've got basically a brand new home for 2/3 the value, right? That's a great model as well. So it's definitely a value add scenario. You're not going to buy a grade A commercial office building for 70 cents on the dollar at a tax sale. I'm not saying it could never exist. That's not a model that I would.
You'll be competing with the Blackstones of the world.
Yeah, exactly.
You're probably not going to make much of an upside on it.
Yeah. Good luck on those. Well, if it even gets to that stage, right? But if it gets to that stage, it's got to be in rough shape.
Yeah, definitely. Cool. So what? So you're more of like a private hard money lender. Is that what that pretty much comes down to?
Yeah, we're not a lender. We are truly a capital partner.
Okay.
Structured, and so it's So it's without getting into the nitty-gritty details of how the structure works, I guess investors can kind of think of us as a bridge financing solution, right?
Awesome.
So in the tax sale space, and actually we found some folks are using our structure, which can be utilized for non-tax sale properties, right?
Yeah.
Anything that requires quick capital can be something that it's like, hey, this is a solution. We built it for tax deeds, but it seems it's very, very flexible into other asset classes as well.
What's the structure look like when you actually are lending it to someone? I know it could be per deal. It's all different and there's different risk for every property.
Mm-hmm.
But like generally, like if it's like a common structure that you guys offer.
So it ends up being a profit share structure. So
Okay.
basically the investor comes to us, says, here's kind of what we typically buy. Here's our model, right? We have a couple $100,000 that we're working with, but we see deals and pass on deals all the time simply because we don't have the capital to buy them. And we come in and say, okay, well, we'll be the capital. We typically require them to put a deposit in escrow, right? That's kind of their skin in the game. And then all these assets are purchased. We help manage that asset until they can get quiet title or clear title and can get it refinanced. And so we're rarely, if ever, and typically never really want to be in these for very long. We can go out to 18 months. We typically like it to be less than a year. Right? So as soon as they can go get financing at a standard financing at a lot better rate, then they go do that, right? And so what ends up happening is that when they do that, there's a profit that's generated from that mechanism, and that ends up being split at that point in time.
Yeah, that's awesome. That's I say this like almost at every podcast that I'm in, but it's like my goal is to be a lender one day, and to have like more. It's like I service a lot of limited partners, of course, and one day to be the limited partner would be great. Is it possible that people can invest with you? Is there a way to find you through that?
There is. The fund that we run it's a 506c fund. So as long as they're accredited investors, then we can certainly have a conversation with them and explore that.
Awesome. And then, so about how often do you guys open the fund or like open a new fund? It's like it's just.
So in Fund 3, which is the one we're operating right now, we created it to be an evergreen open fund, and so it is not a, hey, bring this tranche of capital in, put it to work for 4 years, and then return. It's essentially a note-based structure that we do 2-year holds on, and Fund 3 right now pays out quarterly, and so it's and then typically at the end of that 2-year period, we'll reach out, before then and say, hey, you're going to want to reinvest, right, and keep it going, or you're going to want to get your capital out. And then because we're selling assets all the time, and so if we need to hold back capital in order to basically make due on a note, then we do that, and we just need some planning to make that happen. So we try to make it very flexible for our structure, because we also don't necessarily have a lot of control over how much we're going to need on a basis, right? So we have lined up basically a backstop lender to us that gives us the ability to put stuff on a line, and so we can use it as needed, and then allows us to bring in investor capital as needed as well, and gives us a lot of flexibility there. So we're not sitting on a chunk of capital with nowhere to go with it. Anybody that's run a fund, that's usually a freak out moment of like, what do I do? You don't want to buy just to buy, right? You return the capital, and then you lose relationships. And so we spent a lot of time building Fund 3. We learned a lot from Fund 1, Fund 2, and the things that we needed to implement into Fund 3. And it's funny because I was on a call with I can't remember, the RIA, like the advisor group.
Yeah.
And he unknowingly said usually it's around the third iteration of a fund is where they get it, to where it works the right way. And he didn't even know where we were at. It was kind of funny because like that's exactly what it took. Like we learned some from Fund 1, and then Fund 2 we learned a lot more, and then in Fund 3 we feel like we got the recipe, at least on the fund structure, that works well.
So the one thing I was thinking is, so say with the way I understand what you were saying, say it's 35 million is the goal amount that you want to raise. Say if you're like the first tranche of like $5 million of loans, how did the first 5 million get treated compared to like the last 5,000 or 5 million of debt investors or equity investors?
It's actually through what's called an intercreditor agreement. So it's what that basically says is every lender is on equal playing ground. So the first one lender does not have any priority over the last lender. And so everyone is split equally among the assets that we have. And 35 million is not necessarily our goal, right? There's really no limit to that's just the size of the fund that we're managing today.
Wow. That's awesome. I love it. So where can people find you?
Well, you can always start taxsaleresources.com and even if you go there, chat there, make a phone call, there's a real person on the other end answering the phone, and just say, hey, I heard about Brian on a podcast, and they'll get you in touch with me. I don't know if I can send you my email, Glenn. It's a big long one, bseidensticker@taxsaleresources.com. For anybody that wants to try and write that down, usually it's a lot easier just to click on a button. Those are the two quickest ways to get a hold of me.
Me writing a email and into my computer when I was on my phone sales job, I would every time never the right email. So we'll get that email from you. We'll put it in the notes. And I appreciate you coming on the show.
Well, thanks for having me, Glenn. Hopefully folks learned a little bit. Like you said, enough to get in trouble. Hopefully didn't learn enough to say, hey, you're going to go buy $1 million in liens tomorrow, and learned enough to know, like, hey, maybe speak to an attorney. Maybe, call the National Taxing Association. I'm on the board. I'm one of, I think 20 some certified taxing professionals, but if you have questions and want to get in the space, start there. Don't just go buy. You can go buy. There's nothing that prevents you from doing it. And you might get lucky, but eventually that luck will run out, and then you'll be asking the questions, and that gets a little more expensive education than doing it up front.
That's when the real learning happens.
Mm-hmm. That's the truth. That's the truth. But anyway, thanks for having me. I had fun. Hopefully, people learned a thing or two about the space, and if they're curious and want to learn more, then reach out to me.
Awesome. Thanks for coming on the show.
Thank you for listening to the Millionaire Journey podcast. Please rate, like, subscribe, leave a comment, and share with somebody you think would enjoy listening.